How are commodity mutual funds taxed? In recent news, many investors are curious about the taxation of commodity mutual funds. With the financial landscape constantly changing, understanding these tax implications is more relevant than ever. If you are considering investing in these funds, you likely want to know how your returns will be taxed. Let's break down the key points surrounding this topic. Commodity mutual funds are generally taxed based on the type of assets they hold and the nature of their distributions. The taxation can differ depending on whether the fund is structured as a mutual fund corporation or a mutual fund trust. Additionally, your residency status plays a significant role in how these funds are taxed. For instance, if a Canadian mutual fund corporation or trust disposes of taxable Canadian property and distributes capital gains dividends or taxable capital gains, a withholding tax of 25% may apply to non-resident investors. This is especially true if more than 5% of the amounts paid go to non-residents or non-Canadian partnerships. However, if a tax treaty exists between Canada and the investor's country, the withholding tax rate may be reduced. Another important aspect is the withholding tax on real property exposure. If over 50% of the fair market value of the mutual fund is tied to Canadian real property, resource property, or timber resource property, a 15% withholding tax may apply to certain distributions to non-residents. And like some other taxes, this one does not have treaty relief. However, investors may claim a refund by filing a Canadian income tax return if they realize a capital loss on the investment within a specified timeframe. For those investing through registered accounts, such as registered retirement, savings plans, or tax-free savings accounts in Canada, investment income and capital gains earned within these accounts are generally not subject to withholding tax until withdrawn. However, depending on the investor's country of residence, other withholding taxes may apply to the investment income earned in these accounts. Dividend income from mutual funds is also taxable according to the Amended Finance Act of 2020. Fund houses that distribute dividends are required to deduct tax at source before paying investors. The classification of the fund can also impact taxation. For funds that combine multiple asset classes, such as multi-asset allocation funds, the tax treatment depends on the fund's equity exposure. If the fund is equity-oriented, gains are taxed like equity mutual funds. Otherwise, debt fund taxation rules apply. This classification affects whether gains are treated as short-term or long-term capital gains and the applicable tax rates. Overall, the tax implications for commodity mutual funds can be complex. They depend on the fund's structure, asset composition, investor residency, and the nature of income distributions. Investors should consult a qualified tax advisor to understand the specific tax consequences based on their individual circumstances and the fund's details.